GrowCFO is where finance leaders grow together. Join thousands of like-minded professionals using GrowCFO to access the combined knowledge and experience of the finance leader community. You can join us today, growcfo.net. Hello and welcome to the GrowCFO Show. I'm your host, Kevin Appleby, and today I've got with me Timothee Clement from Agicap. Timothy, welcome back to the GrowCFO Show.
Hello, Kevin, and thank you for hosting me today.
So, Timothy, you're going to be a guest at the upcoming Global Finance Summit. I believe you're talking about selecting the best technologies for treasury and cash management.
Exactly. So, technologies for treasury, cash management, and cash forecasting have evolved a lot in the past 5-10 years with new systems that have emerged from the legacy solutions of the past. And we are excited to discuss this new ecosystem and how it can benefit finance teams that will join this great summit.
It's another challenge for finance leaders to transform the finance systems, processes, technology in yet another area. Everything seems to be changing at the moment. But Timothy, in this podcast, rather than talk about things you're going to talk about in the summit, let's just step back and talk about what's the business case for doing better cash forecasting, cash flow management. If you're going to invest in this technology, what's the business case for doing it?
That's a great question. So we could start maybe from the baseline, the situation for many companies. And we recently had a webinar where we surveyed the people joining, and about 95% of finance teams and treasury teams across the world do their cash flow forecasts on Excel. So they don't do it in an ERP. They don't do it in a cash forecasting system. They do it on spreadsheets. Why? I think the main reason is the complexity of cash forecasting. Cash forecasting is difficult because there are a lot of moving parts, actual data, short-term data, operational, so invoices, orders, all elements that are driving this cash conversion cycle in the short-term operational cash flow of a business. And after this, longer-term projections are also difficult to build. So because of all those moving parts and the flexibility needed to make a proper cash forecast, you need to use Excel, and you spend a lot of time on Excel. The result is that visibility is limited. No one has a lot of time to invest in making the perfect model, drawing from different sources and uploading this data to perfectly fit in a nice cash flow forecast. So as a result, and I think it's an insight from PwC's Global Treasury survey that was released a few months ago, inaccurate forecasting and lack of visibility is the top challenge for a lot of CFOs across the world. Currently, it's their top challenge. And that's where we come to the idea of then what's the value, what's the business case of cash forecast? Why should we invest time and maybe money in getting this right?
I can see an obvious one straight away. You're using an Excel spreadsheet. Well, number one, Excel spreadsheets are prone to mistakes. You only need to get one formula wrong and the whole answer is wrong. And number two, your Excel spreadsheet generally isn't connected to any sort of real-time data. And the one thing about your bank balance is it's changing all the time. So I can see it straight away a limitation in the Excel spreadsheet. But then again, I'd say, hey, so what? We've been using Excel spreadsheets to do this sort of stuff for years and years. Why should I suddenly be worried about changing now? What's going to drive me now to change from something I've been doing for a long time?
That's a great question. And I think what struck me recently is a quote from one of our partners in the US who mentioned most companies are either over-borrowed or underinvested. Either they borrow too much money simply to meet their short-term or long-term needs in capital, or on the contrary, if they have sufficient cash, then they have too much cash, which is not properly invested to draw the corresponding results expected from shareholders. Most companies are over-borrowed or under-invested, and this is often a result of a lack of visibility into short, medium, and long-term cash flow projections.
I guess something that's changed there, Timothy, is interest rates of late. You had too much cash? Well, in some ways that didn't really matter a couple of years ago because the amount of interest you could earn on, say, a spare $10,000 would be next to zero. Come forward 2 years and you can probably easily, just by putting in on deposit somewhere, get 5%. So there is a driver there to better manage where your cash is.
Exactly. Being overborrowed or underinvested 6, 7 years ago, even 3 years ago, was not a problem. The rates were low. It didn't make a difference in your net income at the end of the year. Today, and in the past few years, cash has become important again. It had always been. It became less important with the low rates, and it's king now more than ever due to those higher rates. It's more expensive to get financed. It's also harder to access financing directly. And you also have more opportunities to invest excess treasury in the short or medium term. And so that's where we come from with this idea of business case for cash forecasting. The idea of doing proper advanced cash flow forecasting is to act on two main levels. The first one is to reduce amounts that are borrowed and reduce the rates at which we borrow, so reduce the cost of debt and potentially cost of equity. And on the other side, seize opportunities to invest excess cash. So on those two areas, we have multiple levers to optimize cash flow, not only in the short term, but also in the longer term. So as a summary, increasing the amount of available cash and optimizing the use of available cash.
Yeah, okay. That makes a lot of sense. But still thinking, hang on a minute, running a spreadsheet doesn't actually cost me anything. Buying a system, implementing a system is going to cost me money. So what sort of payback is likely to be expected from doing that kind of business transformation? One side of the business case is the benefits. The other side has got to be the costs.
That's a great question. So let's look at three main areas of return on investment for a solution. Then we can try to size it a little. But first, some ideas. First idea, which is very straightforward, is saving time on manual processes. So let's say today you have a spreadsheet. Yes, it's free. Excel is free. Not entirely, but almost. However, it costs you the time of sometimes a CFO, sometimes a controller, sometimes a treasurer, but it costs manpower to load data, to check formulas, errors, create reports. A lot of manpower is spent. So the first straightforward area of return is the time saving, because you connect to your bank, you connect to your ERP, you connect to other data sources. In a robust system, you already, in most cases, can pay back the investment at least once simply from the time saving. That's the base layer that's very obvious to see and to decide upon. Now, this is not always sufficient, depends on the company, but we look at other areas of return for such a solution, which are optimizing cash. So what we discussed earlier, the business case for cash forecasting, it's not saving time. Saving time is obvious. It's actually improving the way we handle cash flow in the company. Because by freeing up this time, this manual time of low value in the team, we open opportunities to work on higher value topics for the finance team, which are actually forecasting the cash flow in the next 13 weeks, potentially in the next 12 months, to increase the available cash in the business and optimize the use of this available cash. So in the short term, optimizing the working capital requirements to generate more operational cash, spend less with borrowing, and invest more in the business or in interest-bearing financial instruments.
It makes a lot of sense. Though you can take away all of that time playing about with your Excel spreadsheets, that there's probably no cash saving there, because what you're going to do is take the resource that's doing that and reallocate that resource to higher value work rather than getting rid of that resource.
I would say it depends a lot on the size of the team. Of course, it depends if your team is currently overstaffed or understaffed. If it's overstaffed or, let's say, normally staffed, everything going right, people not working too much, then you could potentially, if it's a team, of 3, 4 people, 5 people, free up sufficient time that it's an equivalent of a full-time person. On the other hand, I tend to see, mostly in the US, maybe less in the UK, finance teams that are also sometimes overworked, a lot of processes to run, complex processes, manual processes sometimes. And in this case, they will, rather than have a better work-life balance, hopefully, and also a more interesting job on the day-to-day.
I think that's something worth bearing in mind. It's becoming harder and harder to recruit decent finance people. So therefore, you do end up with teams that are overstretched, not intentionally, because you're trying to really work the resource and get the best out of the buck that you're spending. It's because you possibly haven't been able to fill a vacancy with the right person. So finding any sort of thing that would free up some portion of your existing people's time has to be a good thing. So we're not thinking about doing any of this. This business case is principally not about cutting heads.
It leads to a vast area of return. So beyond optimizing cash flow, which is also to make the right decision. So business partnering between the finance team and shareholders, business owners, and CEO. So using a system that's very easy to use to test scenarios of cash projection. So scenarios of investment, of runway, of M&A or dividends payouts, for example, to have meaningful discussions between the finance team partnering with the board or the executives. The end objective is to be more proactive in making the right decisions and avoid, for example, not acting or waiting simply because we have a lack of information and a lack of forward-looking perspectives, because the systems do not allow to spend time on this. And that's also something we see. I don't know if you agree, Kevin, that maybe about half of finance teams manage to have proper forward-looking perspective, but some are too overworked or too tight and thus need to stick to the most mandatory parts of their assignments, which are accounting, tax, etc.
You've mentioned that scenario analysis. How many people actually manage to put together more than one scenario?
Exactly.
They probably don't look necessarily at all the variables that can be adjusted. And that's going to be powerful. Okay. So as I look at this, I can see that there's a benefit coming in terms of perhaps better invested money. There's a benefit coming in terms of maybe headcount saving, but unlikely. But there's a benefit in putting people to work in better ways. There's a benefit of better information and scenario. But again, cost. Can see all these benefits. What's this probably going to cost me to implement?
That's a good question. So it depends, of course, on the size of the business. For software like Agicap, we'll start for simple setup for small companies between 2 and 10 million of revenue, below $5,000 per year. So that's a small investment compared to the fraction of a full-time person's salary. For larger companies, so let's say small, medium businesses between 10 million and 100 million of revenue that will have more bank accounts, more entities, but also more cash to actually optimize and improve. The average cost will be closer to $10,000, $12,000 per year. It's inclusive of the implementation and the support most of the time. So it means that with this price, you have the software to automate your processes, to make multiple scenarios instead of just one, to partner with the wider executive team, and the implementation as well, which is covered in just a few weeks, as it's an easy system to implement over the existing stack.
Okay, so that's actually a very small amount of money to be trying to get an ROI on, which is good news. So you can easily see that is well less than the cost of somebody's salary. If I look at that in terms of the way I would do a benefit calculation in one of the many business cases that I've looked at, I would look first of all at the hard cash savings. Am I going to save person? Well, okay, in the bigger companies you might, in which case it is already paid for itself. In the smaller companies, well, it's going to be more difficult because you can get rid of whole people, but you can't get rid of arms and legs. So the chance of getting rid of a person because you're doing this probably limited. So then I would think, okay, so I'm freeing up some resource. to do better things. I can put a salary value on that. This is saving me potentially recruiting or whatever that extra level of resource. So fine, but it's a non-cash benefit. It's a little more intangible. Then I can say, well, okay, if I look back and say if we better managed cash over the last 12 months, well, we might have avoided X in interest payments or gained Y in interest from investments. We can probably put a number on that. So, yeah,
Exactly.
so it's starting to build a decent business case. But if I was building a business case, I'd want to present the board with some options, Timothy. So, option A, do nothing, stick with the Excel spreadsheet. Option B, well, you've already mentioned your solution, Agicap, but is there an option C that there might be more I can do within an ERP? Or other that I should be putting in my business case?
That's the tough part. There are not many options. And actually, when we ran this survey a few days ago, let's say 90% were on spreadsheets, 5% on a system, a cash flow forecasting system like Agicap, 5% were on an ERP-like system for cash forecasting. This discussion was around ERP against special purpose systems. And what we tend to see with ERPs is that they are not built for forecasting. They are built for accounting. They are built to work on historical, transaction-based, accrual-based data. So they are a core layer, of course, for any company in the world and for the finance team, but for specific processes related to compliance, accounting, tax filings. And they were not built, especially most of them were built a long time ago, for projections, be it P&L projections or cash flow projections. They are rigid, which is good for what they are built for. It's really important to have strong and clear rules and structure to not miss anything in the accounting and in the tax reports.
Absolutely, because we want these things to be error-free.
Exactly.
We want every transaction to be dealt with according to a set of rules. We want the analysis done properly. We want to comply with IFRS or US GAAP, whichever's dependent. So yeah, absolutely, these have got to be rigid systems dealing with numbers in a certain way.
Exactly. And they deal with numbers in this way, and they are mostly backward looking. They have not been built to handle uncertainty of a forecast. So to handle the vast amount of variables you have in, start with an FP&A, a P&L forecast, but even more with a cash flow forecast. So you can run some basic projections in most ERPs, which are mostly based off what information is already in the ERP, which is payables, receivables, sometimes orders. But you will miss most of the time your rent, your software, your payroll payments, or your longer term cash inflow or sales projections with all the complex internal or external variables that affect the forecast. And I'm not even speaking of scenarios, which are even a longer way to be part of forecasting in ERPs.
Yeah. Okay. So I can see now 3 options, and I suppose there's a 4th option. Let's build a whole load more spreadsheets that can do things in a more complex way, that can give you all the scenarios.
Yeah.
And I guess the downside of that, Timothy, is that uses a lot of effort from people that are probably already overworked.
And I think that's maybe the one, indeed, I would say I would consider the only alternative to option A, doing nothing, and option B, taking on a system, is actually investing in a very well-built and well-connected spreadsheet system. In the past 6 months, launching the US for Agicap, I've talked to about 300 finance teams. I've met one with a very great Excel model. So we are thinking in this case to use Agicap more as a visualization, connecting the bank because they don't have the actuals properly feeding, connecting their cash forecasting model, which is great. So they can visualize it and add the scenario. So they have a great cash forecasting model pulling from a data warehouse with payables, receivables, orders, and their very complex factoring model with multiple lines of credits on top. So it's very complex and very well modelized, but it took them ages to build it. And it's still missing the live balance or transaction updates from the bank to have actuals and forecast. It's also missing the scenarios. So that's why what we are thinking to add with Agicap.
Got some really clever spreadsheets. Still isn't doing everything you can do. So one of the conclusions that I draw out of that then is, hang on, if you've got a talented team, let's assume you have, then you're putting that team's efforts to work with the wrong tools, pulling the spreadsheets together, crunching the numbers, then you are not going to get the best out of that team. If you've got a talented team and you want them to produce some great results, you've got to give them the right tools.
Exactly. And especially in today's constrained environment in terms of recruitment and finding the right people, companies that are using, I would say, state-of-the-art solutions and modern solutions have a big premium in their recruitment capacity of the best talent in finance, because it's always better to work with the right tools for a strong finance person to exploit their full potential.
Okay, so I can see there's a strategic case. We need better cash management. Cash is tight. We can't raise funds as easily as we could in the past. There is a need to make sure we get this right. There's an economic case that says, actually, this doesn't cost very much, and the return on investment is likely to be pretty high. We've looked through some options around there, and we've seen that really to go towards a special purpose system of some sort, whether that's Agicap or one of your competitors, Timothy, seems like almost the no-brainer option, because we can say that even if we invest a lot in spreadsheets, it's still not going to do everything. Anything that's built to an ERP, for the reasons you outlined, isn't fit for purpose. It's fine. So we've got a very strong preferred option almost coming out of here that goes to, well, we need to put a special purpose system in place if we're going to do this properly. So my remaining question would be, the final bit of the business case is convince me that I can implement this and get it to work and know that it's going to be better than what I've got now. So what's kind of involved in that management case in the business case to know that this is implementable and will deliver the benefit?
So the implementation is nothing like an ERP or accounting system implementation. For the reasons we mentioned earlier, forecasting, especially cash forecasting, is flexible. It's not based on compliance or complex regulations that differ across countries. Managing and forecasting cash is the same for any business in the world, and so for any entities you may have in an international group. So what it means for Agicap's implementation is we have three main things to do. In simple case that we run across 3 weeks. In more complex case, will be closer to 6 weeks. So we are talking about a few weeks of implementation.
We're talking a very short implementation timetable in the gamut of finance transformation, where you can get some implementations can take anything 6 months, 12 months. Something is taking best case 3 weeks, worst case 6 weeks. We're talking really at the simple end.
Exactly. And based on three main steps, the first step is the bank connectivity. We are lucky to have had a great progress in open banking. So I'll come back to it. But first step, bank connectivity. Second step, ERP connectivity for payables, receivables, and orders. Third step, all other forecasting items and scenario planning. So we run across those three steps, which sometimes can be as short as 1 week per step. In more complex cases, 2-3 weeks per step. Now, if we dive into each of those three steps, the first is connecting your banks to have automated balance updates and transactions feeding in the platform every day to update the actuals. Open banking has evolved a lot in Europe in the past years, initiated by the UK, so it's very easy to connect all banks across Europe. And the US, it was not the case 3 years ago, but now, especially Plaid, leading provider of open banking connectivity in the US, now enables to connect thousands of financial institutions directly in the US. So most of the banks can be connected in a few clicks, just like in Europe, with a secure authentication process. This is the case for easy connections. Sometimes you will have a bank that's very local, very regional, very old school. It may not be part of the open banking frame yet. In this case, we have other connectivity options, which are file transfer services and SWIFT. So we connect, in this case, directly to the bank. This takes a few days to set up. Once it's in place, balances and transactions are feeding and it's ready. Then we move to the second part.
Just a quick question. You'd normally be also feeding your bank information into your accounting system.
Yeah.
And the accounting system would be applying transactions it's seen going through the bank into payables and receivables. If you're taking a feed direct from the bank and you're also taking the accounting system, isn't there an issue that those lines, shouldn't you be taking them all from the same source?
So 2 parts to this answer. First, why do we connect the ERP? Initially, we'd connect to the ERP not for the actuals, but for forecasting information. Forecasting information is payables, receivables, sometimes orders or project milestones. That's the initial purpose of connecting the ERP. Now, Agicap has two-way connectivity with ERP. So we don't not only pull AP, AR orders for the forecast, we can also push bank data to simplify and automate this categorization and reconciliation process in the ERP, especially in old systems. So it depends which ones, but in some old systems and sometimes some countries, it's completely manual or still fairly complicated to handle. So we bring a new interface, an AI algorithm and custom rules to easily run the pre-accounting, if you need to, directly within Agicap from the bank feeds and the stable bank feeds of Agicap back to the ERP.
Okay, yep, get that.
Which leads us to the second step, which is connecting the ERP. We have direct integrations with most of the major players. So QuickBooks, Xero, NetSuite, Microsoft Dynamics, and some versions of Sage. And we run slightly more custom integrations with the on-premise software like Books Desktop, many versions of Sage and of SAP. So again, a few days to set up a connection so that payables, receivables, and orders feed into the platform.
Yeah.
The last step is to work on the rest of the projections. So payroll, rent, longer term cash projections that we can modelize directly in Agicap in a flexible way, or also use inputs from external models.
So that's relatively simple in terms of the data you're pulling in. I guess the other thing in implementation is training people to use it.
Absolutely. So we run this in parallel. So most of the heavy lifting of the connectivity is done by our teams in the background, working with your bank or working with your ERP if we need to, if it's not connectable directly via API. The rest and all the meetings you have, usually it's one meeting of 45 minutes every week, are entirely about training. So we share the screen on a Zoom meeting, and the users will directly work on the software with their account manager, guiding them through what they need to know, what they need to learn. You can, but you don't need to learn the whole documentation, which is a lot of pages. We will guide you through the 80% or the 70% you need to know to succeed, and the objective of those weekly sessions with all stakeholders that will be.
So we talked about the ROI earlier. We can see that it doesn't take too much imagination to work out how we can have a very good ROI on a relatively small license cost. Now, we're talking in terms of, say, if we're putting Agicap in, you're talking about your team doing all the connectivity and so on, and a period we're going to train the user. So there's going to be a one-off cost of all of that. So typically, what sort of cost are we looking at putting into our business case for that one-off implementation?
Historically, Agicap has not charged any one-off costs for implementation. It starts to be the case in some of our more mature markets where we work with integrators, so consultants who run the Agicap implementation themselves. So some models, it's rather for larger companies. Some models where you have implementation fees and separated from the annual cost of the subscription. But historically, it's included as part of the service.
Yeah. So in terms of the staff training time, you're probably, it's not a real cash cost because you're paying the people anyway. There's a certain amount of lost time while they're sitting in a training room.
I would argue the contrary, because from day one, at least half or 2/3 of your banks from day one, from this first onboarding meeting, your banks are connected. You already have live visibility on your balances, on your transaction. So you can get value from day one, even though next week you will start adding new blocks with short-term forecasts, long-term forecasts, and scenarios. But yes, of course, you need to invest a little time to be trained and to properly use the software. And it can also take some back and forth internally. What do we want to achieve with the software? How do we want to achieve it? What's our priorities? But the baseline is, and the base value is available from day one.
Best part of a business case here, Timothy. We can see the strategic reasons, we can see the options and clear option that we should perhaps go down. We can see the cost and benefit analysis giving us a good ROI. We can see the implementation is relatively straightforward and relatively simple. But what other question would I ask as a CFO looking at the business case to do this and playing devil's advocate? I'd be saying, okay, all sounds too easy. What can go wrong?
What can go wrong? I think from my experience, the most important thing is to have all stakeholders aligned on the project. What I see going wrong sometimes is when either an executive or a finance team member have been involved in the project or in the decision on the software too late, not having time to voice their concerns, their doubts, or their specific questions from their own position, so their daily job as a finance person, or their strategic priorities as a CEO or owner of the business. We recommend most CFOs entering those projects to really put in at the same table all the people that will at some point touch Agicap, either use it or benefit from the decisions and the reports out of it, because that's the main risk, is that someone doesn't understand the ROI, the value, and the reason for this change, because it's a change, it's a digital initiative. That's what can lead to potentially some internal frictions when it's not well brought.
So the key point there is, even on a relatively small implementation, you have to get the change management right.
Exactly.
Identify your stakeholders, work out who's engaged, who's not engaged, corral the people that are not engaged in this with some great communication. I can see a business case coming together that's not too difficult to justify putting a better system in place. Timothy, that is fascinating. Really looking forward to that session at the summit where you're going deeper into the various options that are around in technology at the moment, playing in this area. Because, yeah, it's one of those areas, forecasting good information, looking into the future, is the thing that I think is going to turn the finance function upside down. We've got to finally become those people that look forwards and help the business make decisions, then look backwards and tell them what happened in the past. And it takes so long to tell them what happened in the past that it's almost history by the time it comes out.
Exactly.
Can't do anything about. Timothy, thank you for being this week's guest on the GrowCFO Show.
Thank you, Kevin. It was a very interesting discussion, and I look forward to the GrowCFO Summit.